Now, today what we're going to be learning about is the Paycheck Protection Program, also known as PPP, and the other Critical Cares Act benefits. Our presenters today are Glen Frost, Eli Noff, and Matt Kraeuter. Sorry, Matt, if I messed that up. They are with Frost and Associates, which is a law firm who represents clients nationwide in collections, examinations, and appeals matter pending before the Internal Revenue Service, as well as working with many state taxing authorities. They have practices in Annapolis, Rockville, Baltimore, Ocean City, and also in Florida. Now, they are very knowledgeable on this subject because they work with many business clients. And so without further ado, at this time, I want to turn the meeting over to Eli Noff.
Hi, everybody. Thank you for joining us this morning. Just wanted to welcome everybody and apologize in advance. I've got 4 kids and they're barbarians at the gate. They're going to try to break down this office door at some point. So if you hear noise, just try to ignore it. These are truly challenging times for many reasons, obviously, but we hope to share in better days ahead with all of you. We are Frost and Associates, where we started off primarily as a tax controversy firm in the Annapolis area. We service Maryland, DC, Virginia, and Florida, although we do federal controversy nationwide. We also practice, Matt Kraeuter, partner on the line, is the head of our business law and civil litigation department. We are also practice estate planning and other practice areas as well. As luck would have it, every day things are changing in this arena. A lot of clarifications are coming out from the SBA. Late last night, FAQs dropped about 6 pages worth that we'll try to integrate into the slides. It's become a difficult task to update slides on a daily basis with the information that's coming out, but we'll attempt to provide that updated information peppered throughout as we go through the slides. So we'll just start quickly. The first few slides are just our bios. That's Glen Frost, my partner. That's myself, and there's Matt Kraeuter, as you see them on the video. We also developed a website recently. We launched it, I believe, last week, called askfrost.com, which will be used for other purposes beyond COVID-19. But right now there's COVID-19 page there that has resources, whether federal or state resources. We try to keep it updated daily, if not within a few hours of information coming out. So we have many staff actually dedicated to keeping this site updated. So feel free to go to that site and see if that's helpful to what you need. So we're going to start off. There's a lot of information out there in the bill that's relevant to a lot of different businesses. But where we're going to focus our time today primarily is with some of the larger components of this bill, the CARES Act, and also some information that I believe is necessary to know from Family First Coronavirus Response Act, the FFCRA. And we'll start off with that, transition into other programs, and ultimately end up with the PPP and state updates. That'll be kind of the big outline here of how we're going to move forward. So the emergency paid sick leave, that's part of the FFCRA. I think it's important for professionals to know this, to advise their clients properly. But essentially, employers with less than 500 employees must provide basically a paid sick leave because of either illness or quarantine, that someone is either ordered to quarantine or be in isolation, has been advised by a healthcare provider to self-quarantine in lieu of coronavirus concerns, is experiencing coronavirus symptoms and is pursuing a medical diagnosis. And then so the first 3 are really related to the individual themselves as to what they need to do to isolate or quarantine themselves. And the last 3 are caring for someone described in 1 or 2 above. So this is, again, caring for someone else who might be ill or isolated. Number 5 is caring for a minor child because school is closed and childcare is closed. This impacts a lot of us, I'm sure, on this video chat, including myself, who I have 4 kids at home right now. And experiencing other substantial similar conditions specified by the Secretary of Health, Human Service in consultation with the Secretary of Treasury and the Secretary of Labor. So that's kind of a catch-all. So if an employee is staying home due to one of these six reasons, then they're eligible for paid sick leave. Now, what's the duration of the leave? And if you look at the left side of the screen, full-time employees are eligible to receive 10 days, which is basically 10 business days, which is 80 hours of paid sick leave. Part-time employees are eligible for leave, which is equivalent to their average hours worked in a 2-week period. So for example, if somebody works 20 hours a week, they're not going to receive 40 hours a week of pay. They will only receive the 20 that they normally work. And how is it calculated? So it depends on the reasons. So if you go back to the previous slide, reasons 1 through 3, which are essentially reasons related to that particular employee, they'll be paid the greater amount of either the regular rate or the applicable minimum wage up to $511 per day or $5,110 in the 2-week period, right? Because it's 10 days. So that's for reasons 1 through 3. You get your greater of your regular pay or capped at $511 a day. Reasons 4 through 6, and that includes kids staying at home or caring for someone else, or the catch-all provision at the end. The employees will be paid the greater of 2/3 the regular rate or 2/3 of the applicable minimum wage, capped at $200 a day or $2,000 over the 10-day period. So that's just a great benefit for people currently having to sit at home and care for their children and unable to work. It's a pretty broad provision that allows them to get paid. Now, what's not in the slides here, and which is really the critical component of this all, is that the employer can pay the employee out of the employer's payroll taxes and take a credit. So really the employer is made whole for paying the employee this paid sick leave benefit. However, the employer's share of FICA is not very large, and paying many employees this particular amount of money, their wage, could obviously exceed the payroll taxes that they can credit against. So the IRS came out with a form, I believe it's form 7200, that basically allows for an express refund request, where the employer can say, I'm short payroll tax money to cover this, file that 7200, and there's an express refund from Treasury given to the employer to be able to cover that. So it's just a huge benefit. The next slide is Emergency Family and Medical Leave Act, EFMLA. Again, this is under FFCRA, this is not CARES, but it's important to know. And under this essentially deals with what happens after that 2-week paid sick leave. What's next? What happens if employees still have to remain at home? So again, if you have fewer than 500 employees, it provides up to 12 weeks of FMLA, extended FMLA, for an employee who's been employed for a minimum of 30 days and unable to work, again, because they must care for a child due to school closures or childcare availability resulting from the coronavirus emergency. Basically, the pay is structured at a rate of capped at it's 2/3 structure with capped at $200 for $12,000 in the aggregate over that period of time. So again, huge benefit for employees. This interplays with some of the other payroll tax credits we'll talk later in the PPP that we'll talk about later. You can't double dip. So we'll talk about all of that later. But this is what came out first and what was out there initially. And it's important to know. Matt, do you want to talk a little bit about posting this new requirement and some things that businesses should be considering when it comes to labor law?
Certainly, consistent with the Department of Labor's normal practice, they produce all these
Eli?
postings.
Yeah, I'm here.
Matt needs to speak up.
I'm sorry.
Hey,
Can
Matt,
you hear me now?
I hear you. Sandy?
Okay. Yes, Matt was very quiet. We could barely hear him.
Okay, I'll try to speak up.
Thank you, Matt.
Not a problem. Consistent with the Department of Labor's standard practice of requiring postings all over your break room, they have added 2 new postings with respect to these, the EPSL and EFMLA, and they are available on the Department of Labor website. And you do want to make sure that you're advising and you're doing yourself and you're posting these so that everybody can see what their rights are. They're actually quite helpful as well. They give a pretty nice detail of what each of those programs entails. So just be sure that everybody's doing that. That is a requirement similar to the regular unemployment and paid sick leave or posting requirements that the Department of Labor generally requires.
And businesses under 50 employees, they can qualify for an exemption if they could demonstrate that the leave requirements would jeopardize the viability of the business as a going concern. So it's a carve out for employers under 50 employees, and that's out there. So Glenn, did you want to take over and talk a little bit about the payroll tax credit and the extension to pay payroll taxes?
Sure. So I'm going to get into the two tax provisions relevant to employer taxes in the CARES Act. Keep in mind, these two provisions do not apply if you're going to be applying for the Paycheck Protection Program. So you can either utilize these tax provisions or the PPP provisions. So the first one is a payroll tax credit. And what this credit equates to is it's a refundable tax credit of 50% of the first $10,000 of wages paid by an employer to an employee. So each employee gets up to a $5,000 credit. It's two requirements. You can utilize either of these requirements. The employer's business is fully or partially suspended by government order due to COVID-19, or the gross receipts are below 50% of the prior comparable quarter in 2019. All right. Go to the deferral. Eli.
Yep.
The employer share of the FICA tax during the remainder of 2020 can also be deferred. So what happens is on the employer's 941 return, they can stop paying in the employer share of the FICA tax, and it has to be repaid penalty free in 2 equal installments, one at the end of December 2021 and the other at the end of December 2022.
Great. So Matt, do you want to jump into the economic injury disaster loans?
Sure. A lot of news has been made about the program that Glen's going to talk a little bit about here going forward, which is the Payroll Protection Program, which is the $350 billion program that like I said, is in the news a lot these days, both for good and bad reasons. But the Congress earlier, prior to that, the enactment of the CARES Act, they expanded the applicability of the economic injury disaster loan to try to help businesses a little bit more immediately. This is a program that's run through the SBA. It's an older program. It generally allows for recovery for businesses that are located in a national disaster area. But given that the entire country is now declared a disaster area, everybody is eligible to apply for this loan. That was the first step. The second, and more importantly, it allows for a $10,000 upfront. They call it an advance or a grant. It's an advance on that loan, and regardless of whether you are approved or denied for the loan going forward, the $10,000 does not have to be paid back, which is really important. So it's essentially a $10,000 grant. Although the website, the SBA website currently states that they will be paid within 3 days, I don't think that's a practical reality these days. I was watching the news this morning, and I think they said that in the last 2 days, the SBA has processed more applications, or twice as many applications as they processed all last year. So they're entirely inundated with applications. So I wouldn't be expecting 3 days, but it is supposed to be very quick turnaround on that. Additionally, this loan's a little bit different from the payroll protection loan in another respect, in that this is money actually being funded by the SBA. So it's actually the SBA is the lender and the business is the borrower. Unlike, as Glen's going to talk about here shortly, that the payroll protection program is actually a relationship with a bank. So you can see through here, this is a program that's available to sole proprietors, to independent contractors and to businesses. So it's pretty broad in terms of who can apply for this loan. The standard for it is that you have to show a substantial economic injury caused by this. There's no technical definition of what that is, but I think most businesses will be able to describe an economic injury as a result of this COVID-19 virus.
And we've had clients apply for this, the EIDL loan 10 days ago or so, and they still have not received any word. Even though on the SBA website, it says that there should be a 3-day turnaround. So they're a little bombarded with applications. I also heard that there are tens of thousands of fraudulent applications that have been submitted by scammers. So I think they're trying to weed through those as well.
Right, that's exactly right. When they saw the $10,000 grant that was supposed to be funded in 3 days, I think a bunch of applications were flooded in, and like you said, there was some with nefarious intent. You'll see here on this slide, there's the rates and the terms. It is a 3.75% rate for a standard business, or a nonprofit is a percent less than that. They are deferring any payments for a period of 1 year. It does allow for an up to 30-year repayment period, and they under 25,000, there is no collateral, but above that, they do require that. I believe above 200,000 is a personal guarantee, I think. And it's important to know that you can apply for this program, and it doesn't prevent you from applying for the payroll protection program that Glen's going to talk about here in a moment. You can't have both, though. You can't double dip. You can't get the $10,000 and then also be forgiven those amounts under the PPP. So, but it's important. This is supposed to be a faster process, and it's a more proven process, given that the SBA has handled these types of loans for quite some time. They just changed some of the parameters, so they should be funded a little bit quicker. But it's a great program, and it's something that everybody should be aware of.
And for people who get EIDL loans prior to funding of their PPP loans, you're able to refinance your EIDL loan into the PPP loan, which is a 1% rate. So it went from 3.75% is the EIDL program, 1% is the PPP program. But Matt's correct in that if you receive the grant, that will be then deducted from the forgivable portion of the PPP loan.
Okay, well, we're going to hop into the PPP, the Paycheck Protection Program, which everyone has a lot of questions about, and it seems to be the program that is the most beneficial to small business. But it's basically an incentive for companies. At this point, we all know to keep their employees employed, during this difficult period of time. It made available $349 billion of loans by banks to help small businesses. I heard the president say yesterday, and I don't know how updated this is, but it's basically that already banks have received 40 billion in applications as of yesterday. So that's Monday, right? That's the second business day of this going live. So that's already 40 billion. And I imagine the number is probably much higher than that when you take into account some of the community banks that might have a lag in some reporting. The purpose of these loans are really to maintain payroll. There are allowances to pay rent and utilities expenses and mortgage expenses as well. There is a limitation on that. You can only use 25% of the loan for non-payroll expenses, and we'll talk about that in a little bit greater detail in further slides. Who's eligible? It's small business concerns, concerns with employees under 500, with under 500 employees, and FAQs came out yesterday that further expanded what that means. And there are some carve-outs to allow businesses with over 500 employees, if they meet a certain net worth test of the business under that certain number. I believe it's 15 million, and then revenue, I believe, has to be under 5 million. But largely, It applies to businesses with under 500 employees. Applies to hotels and restaurants where the attribution rules are a little more flexible for purposes of hotels and restaurants and hospitality. Applies to sole proprietors, independent contractors, and self-employed individuals. I mean, that program is going to be opening, we'll talk about this Friday, but the PPP that's currently open and available is primarily for individuals who have payroll expenses. And we'll talk about that in greater detail. Applies to veteran organizations and tribal business concerns as well. So there's certain certifications that have to be made, and this is pulled directly from the application. You have to certify that current economic uncertainty makes the loan necessary to support ongoing operations. I think almost every business can certify that now. Certainly a significant portion of businesses in light of what's going on. There's just a tremendous amount of uncertainty for various industries. You have to certify that the funds are going to be used to retain workers and maintain payroll or make mortgage, lease, and utility payments. Borrower has not received another loan under this program or EIDL. So we'll talk about the interplay between EIDL and PPP, but essentially you can't take the EIDL money, that $10,000 grant, for example, and then also take the PPP without offsetting one with the other. Borrower will provide to the lender documentation that verifies the full-time equivalent employees on payroll and the dollar amounts of payroll costs, covered mortgage interest payments, covered rent payments, and covered utility payments for the 8 weeks after getting the loan. Loan forgiveness will be provided for the sum of documented payroll costs, covered mortgage interest payments, covered rent payments, and covered utilities. So essentially they're going to be forgiving these loans if spent on the allowable expenses, and you have to maintain certain ratios, which we'll talk about a little bit later. All the information the borrower provided in his application, supporting documents and forms true and correct. Obviously, knowingly making a false statement to get a loan under this program is punishable by law. So it's your typical certifications that you'd see, especially that last one. Glenn, do you want to jump into this or you want me to do it?
You can handle it, Eli.
Okay, sounds good. So the maximum, so this goes to how do you compute the loan amount? And the maximum loan amount that you can borrow in the Paycheck Protection Program, and this has been the subject of a lot of dispute, but this goes to the FAQs that came out yesterday, provided a lot of clarity as to this. So you can borrow $10 million, the lesser of 10 million, or the average total monthly payments, average total monthly payroll costs multiplied by 2.5. Now, the dispute has been, so again, that's average monthly payroll times 2.5. So the dispute has been, the bill says it's the last 12 months. The SBA guidance that was put out, I believe on Thursday last week, in the application essentially allows for 2019 as the look back period. So which is it? Banks have been kind of all over the place on this. And some banks are saying, no, it's 2019. Some banks are saying it's a 12-month look back period, the last 12 months, but you can do either one. FAQ came out and discusses that, and let me see if I can pull that up, but it basically discusses that the maximum loan amount can be computed based on either 2019 or the last 12 months. So this morning I updated that.
I think it's FAQ 14, Eli.
Let me pull that and see if I can pull that up. But it basically discusses the look back period for purposes of this, of the PPP loan amount. Here it is. Right, so it's either the last 12 months or 2019. So that's what you can use. So I think that provides a lot of clarity with respect to this. Let me see if I can pull that up right here. So this just came out as of April 6th, right? So information is changing daily. So the question is right here. What time period should borrowers use to determine their numbers of employees and payroll costs to calculate loan amounts? And then the answer is, in general, borrowers can calculate their aggregate payroll costs using data either from the previous 12 months or from calendar year 2019. There's exceptions for seasonal businesses. You can use different periods, either February 15th through June 30th of 19, or March 1st through June 30th, or February 15th through June 30th of 19. If the business was not open during that period of time of February 15th through June 30th of 19, you can use the average monthly payroll cost for the period of January 1, 2020 through February 29th, 2020. And it also gives a little bit of guidance as to the full-time equivalents. When you calculate full-time equivalents for determining the forgiveness on the back end, we'll talk about that a little later, you can use essentially that same period of time that you used to determine the maximum loan amount. Let me move that back over. Okay, great. Now, we talked about the special look back for seasonal employees already in the FAQ. The interest rate initially on these loans was 0.5%, but the banks were complaining because, like Matt mentioned earlier, unlike the EIDL loan, which comes straight from the SBA, these PPP loans are being paid off of the balance sheet of the bank. So this is money that's bank money. And they essentially were earning 0.5% to carry these loans on their books, which is not a lot of money. Yes, there is a fee that they get. I believe it's 5% up to $350,000 in loan origination, and then above 350 to 2 million, I think it was 3%. 2 to 10 million, I think was 1%. But to carry these loans on their books, the banks were concerned. Well, what happens if on the back end of this, the loan is not forgiven, and we have to carry this loan greater than 90 days from now? And it's going to be on our books for a couple of years with 0.5% interest. This isn't attractive to us. So as a result of that, they increased the interest rate to 1%. I mean, that's not such a great increase, but they did increase it to 1% beyond the fee amount as well. There is payment deferral for the first 6 months, which includes interest, principal, and fees, but interest does continue to accrue during that deferral period. Now, when you talk about, and this is very, very important to consider. So one of the big disputes has been, well, how do I compute average monthly payroll? Is it gross payroll? Is it net payroll? I mean, there is language in the bill. I don't have it in front of me now, but it says excludes for purposes of determining what payroll costs from the definition. It excludes chapter 21, 22, and 24, 21 and 24 being employer share FICA, and then also the employees withholdings, the income tax withholdings. So when considering that, it seemed as though when determining the average monthly payroll, that average monthly amount and multiplying that by 2.5, it looked as if that was based off of net payroll. Some banks read it as gross payroll, where it includes both the employer FICA and the employees withholding, and it created a tremendous amount of confusion with respect to how you compute that loan amount. And what has been determined through yesterday's FAQs is that it excludes FAQ 16, I believe it's 16, yes it is, FAQ 16 excludes, basically the only thing that's excluded is the employer share of FICA. So you look at payroll costs, subtract out employer share FICA, and then multiply that average monthly payroll minus employer share FICA times 2.5. So you don't have to exclude the income with the withholdings under for the employees' taxes. So it's just the FICA.
And I'll chime in as well. And you can also include some of the non-cash benefits, which are the health insurance premiums, the state and local taxes paid on behalf of the employee. So they're the unemployment taxes, as well as, then this is a big one, any retirement contributions. So the both the employee deferred 401k as well as the employer match of a 401k program.
So it gives a great example, and we got plenty of time. Perhaps maybe, Glenn, we should run through the FAQ 16 example. Let me pull that up on the screen here. So how should a borrower account for federal, you see question 16, I'm going to highlight it. How should a borrower account for federal taxes when determining its payroll costs for purposes of the maximum loan amount, allowable uses of a PPP loan, and the amount of a loan that may be forgiven? So this goes to, how do you determine what that average monthly payroll is? We know you could look at 2019 or last 12 months, fine, but what gets lumped into the payroll cost? So the answer, under the Act, payroll costs are calculated on a gross basis without regard to, not including subtractions or additions based on federal tax imposed or withheld, such as the employees and employer's share of FICA and income tax is required to be withheld from employees. As a result, payroll costs are not reduced by taxes imposed on an employee and required to be withheld by the employer. But payroll costs do include the employer's share of payroll tax. For example, an employee who earned $4,000 per month in gross wages, from which $500 in federal taxes was withheld, would count as $4,000 in payroll costs. The employee would receive $3,500 and $500 would be paid to the government. However, the employer side, federal payroll taxes imposed on the $4,000 in wages are excluded from the payroll costs under the statute. Now, it's quite a tongue twister if you look at the footnote on the bottom of how they did this big loop to get to this answer, because the language in the bill, it's not that apparent. It seems as though you wouldn't be able to include that withholding amount, but the SBA guidance is clear and it says you can follow it, is that essentially the average payroll costs include employee withholding. It just excludes the employer share of FICA for determining the loan amount. Glenn, you have anything to add, or is that?
No, just the other costs as well.
Correct.
Would be added into that, so that you're just calculating the payroll cost itself. Correct.
Correct.
Eli, this is Sandy. Is there, where can anybody find the FAQs, or are we going to make this available for them?
Why don't I go ahead and, well, I mean, look, if I open my browser like this, you can see it right up there. I could send it to you, Sandy, and you can circulate it around, but it's basically at home.treasury.gov, and you put this long extension. Okay. But what I'm going to do is I'm going to go ahead and email that to you, Sandy, as soon as this is over, okay?
Okay, great. Thank you.
Pleasure. So in moving on, the loan forgiveness, and this goes to the cap of the borrowing as well. So when we talked about the average payroll cost, there's some limitations, right? We discussed that employer share of FICA is not included in that average payroll cost. Well, neither is the amount paid to an employee over $100,000 annually. So if you divide $100,000 by 12, you essentially get $8,333. So essentially the loan amount is capped at $8,333 per employee, which does not, but as Glenn was mentioning just a minute ago, this new FAQ discusses what is included in that $100,000. And I believe, Glenn, that was FAQ 7. And I'm going to put that up on the screen. So when determining, again, average monthly payroll cost, let's take a step back for a second. So you're looking at what's the average monthly payroll cost times 2.5 equals your max loan amount. Now, we've established that employees withholding can be included in that average monthly payroll cost. We've established that employers' share of FICA not included in the amount. And we're establishing that the maximum loan amount is $100,000. The maximum amount of employee pay that can be factored into the average monthly payroll is an annual $100,000, which is $8,333 per employee. Now, it begs the question number 7 here in the FAQ, which came out last night. The CARES Act excludes from the definition of payroll costs any employee compensation in excess of an annual salary of $100,000. Well, that's what we just discussed. Does that exclusion apply to all employee benefits of monetary value? So in other words, benefits beyond that $100,000, can you include those in the average monthly payroll cost that you multiply by that 2.5 factor to figure out your gross monthly payroll, to figure out your maximum loan amount? And the answer to that is no. The exclusion of compensation in excess of $100,000 annually applies only to cash compensation, not to non-cash benefits, including employer contributions to defined benefit or defined contribution, retirement plans, payment of group health insurance and healthcare costs and premiums, and payment of state and local taxes assessed on compensation of employees. So I think that provides a little bit of clarity, further clarity with respect to what that $100,000 includes and covers. So I'm just going to pull this off the screen here so I can get back to the slides. So that goes to the $100,000 amount. And on the right side of the slide, it essentially goes towards what look back period, and we kind of covered this earlier I believe it was FAQ 16 when you determine the max loan amount. But when you're looking at loan forgiveness, there's essentially two criteria for determining the loan, or a few criteria for determining the loan forgiveness amount. One of them is you have to spend it, like we discussed earlier, on payroll costs and utilities, mortgage interest or lease payments. So as long as you use it on those expenses, that's the threshold requirement for forgiveness on the back end. However, the whole idea of this loan, the PPP loan that is ultimately forgiven if spent within 8 weeks on those allowable expenses, the ultimate purpose behind the loan is to keep people employed. So what the government's put in as a requirement in the bill is that you don't reduce the full-time equivalents. You don't reduce your full-time equivalent employees when you look back at your look-back period for determining the loan. So remember we talked about earlier, what is the look-back period for determining that loan? And we looked at the FAQ that came out last night. The look-back period for determining the loan is either 2019 or the last 12 months. So you can look at the same look-back period for the purposes of determining your full-time equivalents for the forgiveness amount. When you compare it back to what you had previously, you can compare it either to the 2019 or to the last 12 months, whatever you used for purposes of determining that loan. There's different rules for seasonal employers and their look-back periods there on the bottom of the slide. But generally, the purpose of this slide is to communicate the following, is that for purposes of forgiveness, beyond using it for the eligible expenses, you have to have the same full-time equivalents. You have to maintain the same full-time equivalents as your look-back period. And beyond that, you also cannot reduce compensation below for any particular employee. You must keep their compensation at, that's the next slide here. The amount of loan forgiveness is reduced by the amount of any reduction in total salary or wages of any employee during the covered period in excess of 25% of total salaries or wages of the employee during the recent full quarter of the employee was employed prior to coverage. So you're essentially looking and making sure that you don't reduce employees' salaries greater than in excess of 25% in order to be eligible for forgiveness on the back end. And that's essentially the rule for forgiveness as well. You can't spend it for greater than $100,000 in annual wages as well. So it mirrors the maximum loan amount calculation on the front end. Matt or Glenn, do you have anything to add so far, or do you want me to push forward on opening dates?
A couple quick points. I saw a note in the chat section about the response from Wells Fargo saying that they're not currently processing applications. We've heard that a lot from a lot of different banks and other people trying to take advantage of this program. Something that you need to take into account is that unlike the EIDL loan program, which is administered through the SBA, this is a loan issued by an independent bank to a borrower. So while they have to operate within the confines of the PPP program as set forth in the statute, the banks can still dictate some of the terms of this loan. You're going to have a promissory note from a bank, and it's secured by the SBA, but it is still the bank lending you this money on their terms. Bank of America got themselves into a little bit of trouble because their initial threshold question was, one, are you a client, is the first question, and two, are you a client that currently has a credit line of some sort with the bank, which a business credit card was sufficient to meet that requirement. However, there was a class action lawsuit filed on Friday because there was a substantial pushback from a lot of Bank of America's current customers who didn't have a current credit facility and just were denied participation in this program. And I think that we're going to see more and more of that going forward in terms of pushback to certain banks. One other important, it's not a legal restriction, but from a business perspective restriction, is that we are seeing that banks are not issuing these loans or providing the ability to apply for these loans unless you are a current client. As Eli had discussed earlier, the terms, frankly, are not particularly that good for the bank if they're going to make 1%. There is the origination fee, but there is a lot of front and back end work for the bank. So our understanding is that the banks have to, on the front side, confirm all of the payroll calculations, as we saw all these FAQs, and they're going to have to go through all these applications and confirm that information, process the application, get it submitted to the SBA, and then on the backside for the forgiveness part, they're going to have to confirm all of that information through documentation and submit that to the SBA. So there's a fairly substantial amount of work on behalf of the bank to process these loans. And if they're only making a 1% return on them, they're not necessarily a good business for the bank. So that being said, we're running into these practical roadblocks to participation in this program that I don't think were expected when Congress had initially drafted this. Another important thing to consider is that when this legislation was drafted, the expectation or the storyline that was being told was it was 15 days to flatten the curve, and that was what people had expected. And while $350 billion is a staggering amount of money, it is not nearly enough. And as we were on this call, I had a news alert that popped up that said that Treasury is asking for another $200 billion already to fund these small business programs. So those are some of the practical implications that people are running into with this program. I still think it's very beneficial and people should absolutely pursue it, but it's not. I don't think it's quite as cookie cutter as they had expected, and the ability to get the money into the hands of these businesses that are really struggling is proving to be quite challenging.
Right, and Bank of America, I think since Matt has opened up loan applications to any one of their clients who has an existing banking relationship with them, as long as they don't have an existing credit or loan relationships with another bank. And I think they've since opened that up after there's been a lot of criticism in that class action that was filed on Friday. I know that a lot of people are upset about that. A lot of my clients are pretty disappointed in their bank, and a lot of community banks are really doing their best also to be able to service these types of debts. There's a lot of brokers out there and agents that are trying to connect people with community banks as well. I'm interested in hearing, I listen to the president's update in conference every 5 or 6 p.m. every day, or 5:30, whatever time that typically is, just to try to get an update as to how much money, because I'm not seeing anything out there right now as to how much money's already been disbursed versus how many applications have been received. I mean, have people actually received money in their hands yet? And then also how much in applications have already been received. And that goes to the point of, how much money is still out there, and is there any time left to be applying for these loans? And Friday, we'll talk about the next slide in a minute, but Friday is essentially, why am I going through that now?
I see Mike Davis just asked a question. Mike, your question is, any thoughts about the fact that $350 billion Wells is only providing $10 billion as one of the biggest banks in the country? My thoughts to your question. So my understanding is Wells Fargo has some restrictions in place that were put in place right after the fraudulent accounts scandal. And so Wells Fargo is kind of highlighting those restrictions to the federal government and saying, look, you put these restrictions in place, we can't lend anymore. My understanding is the federal government's given them guidance that, hey, they can overlook this restriction. But I think it's more of a kind of marketing publicity for Wells Fargo they're really trying to force the federal government to lift their restrictions entirely. That's my understanding, Mike.
And I heard that as well, Glenn. That sounds right. So when and where can you apply? So I'm sorry, I don't see any of the questions for whatever reason. Maybe I'm not looking at the right screen. So Glenn and Matt, if you have them covered, that's good to go. When and where can you apply, which is the next slide. So April 3rd, last Friday, was the opening for small business, was the opening actually for businesses and people who have payroll. April 10th is going to be the opening for independent contractors and self-employed who do not have payroll. Guidance is yet to come. I think there's going to be a lot of information a lot of questions we have about how that practically is going to work. Because we know when you think about the PPP now and the amount of money a business is going to receive, it's quite obvious how you spend it, right? So if you have employees, you're spending it on the employees' wages, the payroll, utilities, rent, but particularly on the payroll side, minus the FICA, the employer share FICA, plus you get to spend it on, the benefits, healthcare, and retirement. Now, for the forgiveness side, for self-employed individuals, how's that going to work, right? There is no payroll. So if you're a Schedule C, a sole prop, and you just have some net income, is it essentially just going to give you that amount of money and then forgive it? As long as it's up to that 8333 times 2.5. How's that going to work? And I think that, as you see, which is kind of disappointing, these FAQs came out yesterday after $40 billion of applications have already gone through. And a lot of clients are going to have difficulties now with their banks that are going to push back and say, well, you used the wrong look back period. You used 19, or you used the last 12 months. You should have used this, you should have used that. And they could be fighting back on these issues. In addition to, well, how did you compute the gross payroll? How did you compute the amounts? How did you compute the average monthly payroll? Did you go gross? Did you go net? And I think these are some of the concerns now, that how are these applications going to go through? I think that in the FAQs, they do outline that if you have the ability to go back to the bank, and if it hasn't yet been pushed through, you can go back and make some modifications to the applications. But it's just saying basically follow your bank's guidance as whatever happens next. And I think that's really disappointing for a lot of people that have submitted those applications already.
Hey, Eli, there was another question, and I don't know if it was addressed in the FAQs with respect to the rent cost for the forgiveness. If the question was if there's a triple net lease that includes a lot of additional costs, real estate tax and CAM and other fees, is that all includable in the rent for the forgiveness, or is it strictly the rent?
So I haven't seen anything in the FAQs about that. The FAQ is 6 pages long. I haven't seen anything in there. Glenn, have you seen any guidance on that beyond the FAQ?
No. So the guidance is, as of right now, that the lease had to have existed as of February 15th of this year. I believe as of right now, you would look to that lease and see what you're obligated to pay during your 8-week forgiveness period. And those are the amounts that would be forgivable. But I am sure that the SBA will put out additional guidance on this issue.
Right, and that goes to the forgiveness on the back end, which right now they're still triaging how to figure out the maximum loan amounts and how to get these applications in. But when it comes to how to spend it and how to get the forgiveness on the back end, I think there will be more information forthcoming on that. So to recap on the PPP, you're talking about average monthly payroll costs, either the last 12 months or 2019. That average monthly payroll cost is capped per employee up to $100,000 annually. That $100,000 does not include benefits and health insurance. It is that average monthly amount does not include FICA, employer share FICA. It does include all the other withholding taxes, and you multiply that by 2.5 to get your max loan amount. As long as you spend it on eligible expenses, so you spend it on payroll, you spend it on rent, you spend it on utilities and mortgage interest, you spend it on the mortgage, as long as you spend it on those particular expenses and you don't decrease wages below 25%, you don't spend more than $100,000 per employee, and you keep the full-time equivalents the same as your look-back period. And for the look-back periods, you can look at, I believe, slide FAQ 14 in the guidance, which talks about in the last paragraph what that look-back period is for purposes of determining the forgiveness amount. As long as you spend that within that 8-week period of time on expenses that were in force as of February 15th, 2020, then you should be eligible for forgiveness on the back end of that. So that's the nutshell of the PPP that was open this past Friday for people with payroll, people that do not have payroll and are self-employed. That will open this coming Friday. I hope guidance comes out before the applications go in, unlike this time around where a lot of the guidance is coming in afterwards. I know that a lot of people are submitting applications that are not in conformity or have submitted applications that do not conform with the FAQs. What does that mean for the loan? Will it get denied? Does it mean that they'll get the money and then on the back end, it just won't be forgiven? Again, it's a 1% loan. It's not the worst thing from a loan perspective, but when you're talking about cash flows and businesses expecting that this money is going to be forgiven, and then they're going to discover later after they spent it that it's not, I think that's a serious problem. So I think people have to look at, I think we as professionals have to look at the applications that were submitted and advise our clients as to how much of that is going to be forgiven, or how to spend it properly so that it will be forgiven. And I think there's a lot of benefit advisors can provide their clients now at this point in time.
And just to add to that, Eli, I think there's also some important business considerations that need to be taken into account. Specifically, you are going to end up with a new indebtedness to a bank. And while on its face doesn't seem like a major problem, you have to look at your current indebtedness, if you have any, and that if you're going to trigger any default provisions in there, a lot of times you're going to need a waiver from your current lender to incur new indebtedness. If you're going to have any collateral on these loans, if it's going to affect collateral that's already used for other indebtedness. And you really just want to be careful and thoughtful about this because you are taking on a new loan and you want to look back at your current situation and understand what, if any, impacts this program will have on your current agreements with your banks. Although a lot of people will probably have a relationship with their bank that they're borrowing from under this program, so it shouldn't be a problem, but it's something that you want to take into account before you dive headfirst into this program.
So we'll move beyond the PPP. The Maryland state programs, in good fashion, as the FAQs on the federal side came out last night, we received an update today on the Maryland state programs that they're largely no longer enforced. So we received word from the Maryland Department of Commerce. They basically had a $10,000 grant and a $50,000 loan available that applications that are already started can be completed by 5 p.m. today. But after that, they are no longer accepting any more applications for the $10,000 grant or for the $50,000 loan. That's the Maryland Department of Commerce programs, and that's kind of late breaking news. I think we discovered that about an hour before the conference today. Beyond that, the Maryland Department of Layoff Aversion Fund, there was also a $50 loan. I believe, if I recall correctly, that may already have been exhausted as well. So I think largely the Maryland programs, good to know what was out there. Maybe there will be more funding as this crisis continues, hopefully not for much longer, but there may be a re-up of the funds available to fund these programs. So I would keep an eye on them. These slides are there for informational purposes. I mean, quite frankly, when these slides were prepared, the money was still there and they were still accepting applications, but it's still worthwhile to know of these programs just in case they do get refunded. Just like the government program, the federal programs sound like they may be. So keep those in mind. And Matt, did you just want to talk about some unemployment benefits that are generally available right now on the federal end for employees?
Yeah, just very briefly, through several different acts, the unemployment benefits have been expanded in 3 ways. One, individuals that formerly were not yet eligible for unemployment are now eligible. That includes self-employed, independent contractors and gig workers and people with insufficient work history. They're now eligible for unemployment. So that was in terms of expanding who is eligible. In addition, they expanded the length of the eligibility. So it's how long you can get these benefits. And then lastly, a lot of news was made about the $600 additional weekly benefit. So that's the how much it was expanded. So the unemployment has been expanded fairly dramatically. The systems are bogged down. As of a few days ago, the Maryland unemployment website did not even allow for submission for the new categories of individuals as self-employed independent contractors. That should be updated soon. But these are really important programs and worth considering when you're looking at the payroll protection plan, whether you should have employees stay on unemployment or whether you want to bring them back and pay them under the payroll protection plan.
Right, and that begs the consideration, Matt, and you touched a good point, whether the PPP, is even a good benefit for a particular employer. So certain employers that are entirely shut down and are not going to reopen during the period of time. You want to touch on that as to how that consideration should go into effect?
Right. Yeah, it's really important that, I frankly think it's a giant hole in a lot of these programs is that, as we've seen, a lot of businesses are just completely closed. So it's difficult for them to continue to pay people if they're not even open. So considering unemployment is really an important consideration, and it's a good value to a lot of people. We were talking to one business owner yesterday, and I believe he said that anybody that made under $65,000 a year was actually making just as much through unemployment or more. So it really is taking care of a lot of people, and it's a good benefit.
Particularly with the federal supplements, and when you consider a business that's shut down that may have many employees, and you have to come out of pocket for employer share FICA, right? And you can't use the loan amount for that. Then when you take that into consideration, somebody who's paying employees to sit at home and has a significant amount of employees, it could potentially result in a situation where they're coming out of pocket for the FICA. Now you can spend up to 25% of the PPP loan and have it forgiven on expenses other than payroll, like rent. So there is a balancing there that needs to go into effect, an analysis of what's the greater benefit, right? What's the lesser of the two evils? Can they borrow the money? And and when they weigh their employer share FICA and all this other money that they get to use on other expenses, where do they come out ahead? So I think that's really important to think about. And an overarching message here, and I think Glenn touched on this earlier in the presentation, but now that we have context, it helps think about it a little greater, is that you cannot use the payroll tax credits and the deferral of the payroll taxes and the EPSL, the paid sick leave, and the EFMLA. You can't use that in the PPP. You can't double dip on these programs. And I think that's really important to mention. So if you're using the PPP and you're taking the money to be able to pay people, you can't also dip into payroll taxes and use that payroll tax money to pay your employees, thereby, the government covering that money twice. And I think that's really important to note here. So, I think that's really the rest of the slides. The rest are just informational about our practice areas. And that's pretty much it on our end. Guys, do you see any other questions that are out there?
Eli,
Yeah,
go ahead, Glenn.
I'll answer Mike Davis's question. So Mike, contact me offline. There are a couple lenders that are doing these loans for non-clients. It's very, very, very limited right now, but we have a couple of connections that we can hook you up with, Mike.
Are there any other
Okay,
questions?
great. All right, we did capture some of the chat area when the questions came up. If the questions were not answered, I'll send them off to Eli, Glenn, and Matt and see if they can do some direct contact with our attendees and so that they can get those questions answered. I want to thank Matt, Glenn, and Eli for taking the time today, because I know they're very, very busy, not only with the company and their business and their clients, but also, as Eli stated, with family commitments, and it's a real juggling act right now. And I just want to thank you all and applaud you for the job that you're doing for us as a society, because you are always there for us when we need help. And I want to thank Frost & Associates for all what they do for MSATP. So I just want everyone to be safe, stay inside, wash your hands, and hopefully we'll see each other face to face sometime soon.